Welcome back to Finanzergy, your go-to channel for all things financial. If you've been wanting to start investing but don't know where to begin, you're in the right place. Today, we're diving into the ultimate beginner's guide to investing. Whether you want to grow your savings, plan for retirement, or build long-term wealth, investing is one of the most powerful tools to achieve your financial goals. So let's break it down into simple steps you can take right now to get started. Let's jump in. 1. Why invest? Understanding the importance of investing. Before we get into the how, let's talk about the why. Why should you invest in the first place? Well, the main reason is that saving alone won't help you build wealth in the long run. Inflation eats away at your savings, so if your money is just sitting in a bank account, it's actually losing value over time. Investing allows your money to grow and work for you. Whether you're investing in stocks, bonds, or real estate, the key is to put your money in a place where it can grow faster than inflation. And that's how you start building long-term wealth. 2. How to get started? Step-by-step plan. Now that you understand why investing is so important, let's talk about how to get started. The first step is to set clear financial goals. What are you investing for? Is it for retirement, buying a home, or just building wealth? Knowing your goal will help guide your investment strategy. Step 2 is to create a budget and make sure you have an emergency fund in place before you start investing. You don't want to be pulling money out of your investments in an emergency. Step 3 is to start small. You don't need thousands of dollars to begin. Platforms like Robinhood, E-Trade, and Fidelity let you start investing with as little as $5 or $10. So, there's no excuse. Get started. 3. Types of investments, stocks, bonds, and more. Now, let's talk about the different types of investments. As a beginner, you'll likely be looking into stocks, bonds, mutual funds, and ETFs. Stocks. Buying shares in a company means you own a part of that company. Stocks can offer high returns, but come with higher risk. Bonds. When you buy a bond, you're essentially lending money to the government or a corporation. Bonds are typically safer than stocks, but they offer lower returns. Mutual funds. These are collections of stocks and/or bonds that allow you to invest in a wide range of assets at once, which helps with diversification. ETFs, exchange-traded funds, similar to mutual funds, but they're traded like stocks on the stock exchange. They usually have lower fees and are more flexible. Each of these investment types has its pros and cons, so understanding your risk tolerance and financial goals is key to choosing the right one for you. 4. Diversification. Don't put all your eggs in one basket. One of the golden rules of investing is diversification. Don't put all your eggs in one basket. By spreading your investments across different asset classes, you reduce your risk. For example, if you only invest in one stock, you're relying on that company's performance. But if you invest in a mix of stocks, bonds, and other assets, you minimize the chance of losing everything if one investment goes south. Diversification doesn't mean you need to buy 100 different assets, but you should at least mix up your investments between stocks, bonds, and perhaps some real estate or index funds to help balance risk and reward. 5. Risk versus reward. Understanding your tolerance. When you invest, you're taking on some level of risk. The goal is to find the right balance between risk and reward based on your financial goals and risk tolerance. High-risk investments like stocks or cryptocurrency can offer high rewards, but they're also more volatile. Low-risk investments like bonds or savings accounts offer lower returns, but they're safer and provide more stability. As a beginner, you might want to start with a more conservative approach, such as investing in ETFs or mutual funds, and gradually add higher-risk investments as you get more comfortable with the process. 6. Dollar-cost averaging, investing consistently over time. One of the most powerful strategies for beginners is dollar-cost averaging, DCA. This means you invest a fixed amount of money at regular intervals, regardless of the market's performance. Why is this important? Well, the stock market can be volatile, and it's hard to predict exactly when is the best time to buy. With DCA, you reduce the risk of investing a lump sum of money at the wrong time and smooth out the ups and downs of the market over time. For example, if you invest $100 each month into an ETF, you'll automatically buy more shares when prices are low and fewer shares when prices are high. Over time, this can help you achieve better average returns. 7. Tax implications, understanding capital gains and taxes. Another important factor to consider is the tax implications of investing. When you sell an investment for a profit, that's called a capital gain. Depending on how long you've held the investment, you may pay different tax rates. Short-term capital gains are taxed at higher rates and apply to investments held for less than 1 year. Long-term capital gains are taxed at lower rates and apply to investments held for over a year. If you're using tax-advantaged accounts like an IRA or 401k, you can also defer taxes or avoid them altogether until retirement, which is why these accounts are such great tools for long-term investing. 8. Common mistakes to avoid as a beginner. As a beginner, there are a few common mistakes that many people make, and you'll want to avoid them. Trying to time the market. It's tempting to think you can predict short-term market movements, but this is a strategy that almost always fails. Stick to a long-term plan and stay invested through ups and downs. Focusing on individual stocks. While picking individual stocks can be fun, it's risky and requires a lot of research. Diversification is key. Panic selling. When the market drops, it's tempting to sell everything. But keep in mind that markets recover over time. Stick to your plan and avoid knee-jerk reactions. 9. Start small and grow your investments over time. As a beginner, you don't need to start with thousands of dollars. The key is to start small and invest consistently. As you gain more experience and confidence, you can gradually increase your contributions. Remember, it's not about how much you invest at first. It's about building the habit of investing and growing your wealth over time. Every dollar you invest today will work for you tomorrow. So start as early as possible to take advantage of compounding. And that's a wrap on our ultimate guide to investing for beginners. We've covered everything from setting goals and understanding risk to choosing the right investments and avoiding common mistakes. Now it's time to take action and start building your financial future. Don't forget to like, share, and subscribe to Finanzergy for more expert tips and tricks on investing, saving, and everything finance related. Thanks for watching, and we'll see you in the next video.